Good afternoon, everyone. This isn't a worship service, so those in the back who can't hear as well as they once did, you can move up if you wish to. There are quite a few seats left. My name is Lee Bridges. I'm a representative of the State University's retirement system. I provide individual retirement counseling services and group presentations for SURS. I've been with the retirement system since March of 1991, so 16 years this spring. Today, what we're going to do is to give a general overview about the retirement system. I will take questions as we go, so please feel free to ask them. There are no dumb questions about a retirement system. It's a very complex and complicated machine, and your benefits are what it spits out, so it all pertains to you. I always like this first slide because everyone in this room is going to retire, or they're not. And if you don't, in that case, it's probably more an issue with your family or your spouse, but we'll plan on all of us getting there. This retirement system was created in 1941 to provide benefits to the University of Illinois. It expanded in the early 60s to cover community colleges, which were established at that time. In 1998, we introduced what's called a defined contribution system. For those of you who were in the system at that time, you received a huge packet of information and had to make an election as far as the SURS retirement system goes. And for those who have entered the system after that date, you've noticed you have to make that big election. So that's when we introduced that plan. In the alphabet soup of the IRS tax code, we are a 401A tax designated plan. So we fit within that 401A code or paragraphs in code of the Internal Revenue Code. We are a non-ERISA governed plan, which simply means that the legislation that affects private retirement packages does not affect SURS. And we are governed by the compiled statutes of the state of Illinois or Illinois state law. I want to touch on a few of the things that we do, and I'll drill down into disability and disability retirement because the presentation itself doesn't cover that information very well. But we do provide retirement benefits, temporary disability, long-term disability, repayment of refunds, death benefits, and survivor benefits. As far as disability benefits go, SURS provides a temporary and long-term level benefit. Each of us, by virtue of at least 2 years of employment within the SURS system, qualifies for the temporary disability policy. Now, it is an own occupation policy so that if you are unable to perform the duties of your position, your doctor certifies that, and our medical examiner agrees, you qualify for that temporary disability benefit. It is payable at 50% of the salary at the time you became disabled. The length of time it can be paid, and I'll use a very generalization here, typically the benefit will last about half of the length of time you've been a member of our system. I use that loose calculation because the technical calculation is that you can be paid while on temporary disability an amount equal to half of the earnings while a member of the system. And typically that works out to about half of the length of time you are actively employed in SURS. Now, at the time that benefit would expire, if you are not eligible for retirement, age-wise or service credit-wise, you can qualify for the disability retirement allowance. Whereas temporary disability benefits pay out at 50% of salary, long-term disability or the disability retirement allowance pays out at 35% of your earnings at the time you became disabled. It is payable for your lifetime. And the interesting thing about our temporary benefit, to go back to that for a second, is that while you are receiving it, you continue to earn service credit just as you were as an active employee. We continue to assume earnings credit for the period you are receiving that temporary benefit. So it's just as if you were actively contributing to the SURS plan, or at least actively working in the SURS plan as far as earnings credit and service credit goes. And interest is also accrued at the same rates for every member in our system at 8% this year and varying rates in the past. So the real downside of the temporary disability benefit is the fact that you have to use it. It continues to earn service credit and bring you closer to that retirement date. Now, each of you knows just by virtue of your employment here, if you are employed for at least 4 months and it is expected to be consistent employment, you will contribute to this retirement system. And any public education institution in the state of Illinois, community college or university, contributes to this plan. So if you have an opportunity to move to another community college, you will contribute to the same SURS account. You will continue earning service credit just as you have here. Now, each of you knows by virtue of that huge packet of information when you made an election either a number of years ago or more recently, there are 3 different plans within SURS. There is the traditional benefit package, which provides guaranteed retirement annuity benefits and survivor benefits that are automatic. A survivor is a spouse, dependent child, or disabled child, someone dependent on your income. The portable benefit package, which we introduced in 1998 along with the self-managed plan, provides a lot of the same guarantees that traditional does. Guaranteed annuity, payable for life with the 3% increases. It removes the automatic survivor benefit. So you no longer have automatic benefits payable to a spouse upon retirement. You must choose to elect to provide that benefit at that time. The self-managed plan is a purely defined contribution plan, which is similar to what you would contribute to either as a voluntary plan here like the 403B or 457 plans, or if you worked in the private sector and had a 401k. You make a contribution, that contribution is allocated based upon your elections. If you meet the vesting requirement, there's a state match. The state match is approximately 80 cents on the dollar. So as long as you meet the 5-year vesting requirements, both the employee and employer contributions are yours, and at the time you leave this system, you can move on and choose to take a separation refund and transfer those to another employer. Each of us contributes 8.5% to SURS. 0.5% is set aside to fund benefits for the health insurance program. 6.5% for those in traditional and portable. You can see the breakdown is very similar. 6.5% is set aside for retirement. 0.5% is set aside for your automatic annual increases. So during retirement, SURS provides a 3% increase every January 1. You are actually funding that as you are contributing to your plan. 1% within the traditional plan is set aside to fund a benefit for that spouse, dependent child, disabled child, or dependent parent. Whereas in the portable plan, if you choose to receive a monthly annuity and you've chosen portable, that 1% is absorbed by SURS. That's what I tend to call the cost of choosing portable if you do choose a monthly annuity. Now, to get back to the traditional side, if at the time of retirement you do not have one of those qualifying survivors, or what I tend to say is you're unencumbered, there's a portion of your SURS account that we have allocated for that benefit. And if there's no one to pay it to, it goes to you as a lump sum or as a monthly annuity. The self-managed plan, the full 8% is allocated based upon your elections. The employer contribution, and I want to make sure everyone gets the full story here. The employer contribution, if you choose to receive a retirement annuity and you've chosen the traditional or portable plans, the match is $1.40 per dollar. Within the portable plan, if you choose a lump sum monthly annuity, or if you choose a lump sum, and we'll get into detail more about the breakdown on that lump sum, but if you do choose a lump sum with portable, the match is $1 for dollar. Within the self-managed plan, the way it's listed here, it's 6.6% of payroll, which ends up being about 80 cents on the dollar. So there's a differing employer match with all 3 plans depending on your election. Now, each of you in the traditional and portable plans doesn't have to worry about selecting investment options. In the self-managed plan, there are two providers, Fidelity and TIAA-CREF. They offer over 30 investment choices that run the gamut from stable accounts to international investments. Vesting is one of the key things that members want to know in our system. If you have at least 5 years of service credit within SURS, and the way we credit service is a little more liberal than having to work from a calendar date to a calendar date. So, and this isn't listed in the information, so you might want to jot it down if you do have a pencil. The service credit year within SURS begins in September, it ends in August. If you work at least 8 months out of that period, you have been credited with a full year. That's why you may have colleagues that have chosen to retire at the end of the spring semester or sometime either April or May or even June. You've earned a full year of service credit. There's no additional service credit that's earned between May and the end of August. So that's one of the benefits of this system. Sick leave is also creditable as service and can help you meet the vesting requirements. 5 years of service, and in this case it could be as short as 4 years and 8 months, would meet the vesting requirement for is what we would call 5 years of service. That entitles you to a benefit at age 62. I've been counseling for 16 years and I've not seen an instance where if you leave the system and you're not working in SURS, you're working in the private sector or at some other employer, if you've met the vesting requirement, start the pension as early as you are eligible, regardless of what you're doing in the private sector or on the outside. This, unlike the private sector, is an inexhaustible stream of income. It dies when you die. So starting it earlier entitles you to more income over your lifetime. Now, there will be those that say, well, if I wait, there will be an increase because there's interest credited to the SURS account and the retirement annuity does increase if you choose to defer. But what I tend to look at is, what are you leaving on the table each month that you could have received a retirement benefit? And over time, what is paid to you on those during that earlier time typically can't be offset if you were to wait for a later date. So for those who don't retire from COD and leave early, leave the assets within the SURS system. You can always choose to take a separation refund. So you can always contact SURS and take the money out. But leave it there. We will credit interest at 8% this year. Typically, the Board of Trustees sets that rate. It has varied between 7.5% and 10% since 1982. A very good rate of interest for you not having to make any elections. And leave the assets here, choose to take the retirement benefit at age 62, or if you have 8 years of service, it can begin as early as age 55. If you meet the requirement of 30 years of service, you can retire at any age. The earliest retiree I've seen, and in fact I helped retire, was age 46. And interestingly enough, the earnings limitation, if you work in our system and return to a SURS-covered employer. In her case, she came back to work after 60 days, which is one requirement, and she worked with her employer for another 2 years. Now, within our system, you can return to a SURS-covered employer and earn, if you retire before age 60, an amount equal to the SURS benefit. So if we're paying you $2,000 a month, you can return to work and earn $2,000 per month. That amount increases as your retirement annuity increases by those 3% each year. So there aren't a lot of tremendous restrictions on SURS employment post-retirement. If you retire after age 60, there's a different earnings limitation. It ends up being the difference between your highest 12 months of earnings in our system minus the annual annuity. So if you've established a pension benefit of $30,000 a year and the highest earnings ended up being $50,000, and that earnings rate includes any vacation pay that you have accrued and are paid for at the time you leave employment. So if the earnings rate was $50,000 and the pension is $30,000, you can come back to work and earn $20,000. The post-age 60 earnings limitation is a fixed number. So it will be $20,000 for the rest of your life, whereas the pre-age 60 earnings limitation is tied to the retirement annuity itself, so it will increase over time. Okay, what counts as service credit? Well, of course, it's the time earned as an employee. It is unused and unpaid sick leave, and we credit up to a year. If you were in presentations in the past, you probably heard me say, well, you know, the TRS system recognizes up to 2 years of service. I anticipate that we will have legislation that passes that provides that same understanding as far as sick leave. Well, it hasn't happened yet, and I don't anticipate it in the near term. So at least we're looking at 1 year at this point. Yes?
There are, if I'm not mistaken, 5 retirement systems in Illinois, and we're at 1, and TRS is at 2. How about the others?
There are actually, and this will be listed in just a couple of slides, there are 13 different reciprocal retirement systems in this state. So I tend to say the state of Illinois, in its infinite wisdom, found 13 different systems to do essentially the same thing for different groups of employees. So there are quite a few, which gives you the advantage of being able to move within the public realm to another employer and contribute to a system similar to SURS and have that credit combinable at the time you would retire. Repayment of refunds is another type of service credit that some of you may have experienced. I have a number of people that will come to me and say, well, I came here and I worked a couple of years and I left and I knew I was never coming back, so I chose to receive a separation refund and now I'm back. Well, as long as you're back for at least 2 years, you have the opportunity to repay that refund to SURS to reestablish that prior service and reestablish service credit, which will help you meet that vesting requirement. Prior service is service in the SURS system. It is at least half-time employment. It has to be verifiable at that prior employer, which is any of the SURS-covered agencies. And as long as it would have occurred prior to 1991, which was when everyone was mandatorily entered into the SURS system, prior to that date, you could have worked in our system but not paid in. And for the periods that you worked in the SURS system at half-time or greater and didn't contribute, you have the opportunity to make a contribution to buy that time in. Other public employment, for most of us, is going to be any time, full-time employment spent in a public school in the United States that you are not entitled to a retirement benefit from. And any of that employment, regardless of whether it's teaching or in any other position, that can be credited as additional service credit within SURS. Military time is 2 years of active duty within the SURS system, or within the U.S. Armed Forces. And it does have to include an honorable discharge. Leaves of absence are any time you choose to work at less than your full-time rate of salary and it is established through Human Resources that you are taking a leave of absence for some percentage or even 100%. You have the opportunity while on the leave to make a contribution to SURS to make yourself whole for the period of that leave. You also have the opportunity, if you choose not to do it on the leave, to make a contribution after returning. Now, the key with leaves of absence is that you return to SURS-covered employment at the same percentage or full-time post the leave and work for a period equal or longer than the leave. So if you take a leave of absence for 6 months, you must return for at least 6 months or greater to have that leave creditable as service. As I mentioned earlier, reciprocity involves all of these different systems in the state of Illinois, and it includes a number of systems. I won't list them, the county systems, the city systems, there are numbers of them. If you've worked in the public sector and contributed to one of these systems, as long as the employment was at least 1 year, it is creditable under the Reciprocal Act, which means all of the time will be combined as if it were in one system. You will receive any number of checks depending on the number of systems you're involved with. They will issue a payment based upon the average salary that is the highest in the systems and based on their service credit. As I mentioned, there's a long list, so. Now, there are a number of formulas that SURS uses to establish retirement benefits. The general formula is very straightforward, and this is for traditional and portable members. A general formula is, again, very straightforward, 2.2% times the years of service. The money purchase formula is shrouded in a little more mystery, but it's relatively straightforward. For those members who were hired after July 1 of 2005, there is only the general formula. Minimum annuity and guaranteed formulas are for those typically part-time employees, and police and firefighter formulas, well, that's pretty descriptive. The general formula at 2.2%, in this example, a member with 28 years of service at age 60, and 60 is significant because it is our normal retirement age, unless you meet the 30-year requirement. There may be penalties that are assessed if you choose to retire before age 60. In this case, 28 years provides, or times 2.2 provides 61% of the average salary, 61.6% times the average earnings, and that average is interesting because it can either be the last 48 months of earnings plus paid vacation up to 56 days, or your highest 4 consecutive years. Typically, this happens with faculty members that don't necessarily want to retire but want to work less. They choose not to work summers or overloads. In the last years prior to retirement, their earnings drop. Well, SURS will look back at the highest 4 consecutive years. It doesn't necessarily need to be your last years. With the 48-month calculation, what I tend to suggest is that you try to accrue as much vacation as the college will pay for, because that vacation, in addition to being received by you, is creditable as earnings and factors into this general formula very nicely. In this case, the 61% times the average salary provides a benefit of $29,783, or a monthly benefit of $24.81. The reduction due to considering retirement before age 60 is significant. It is 0.5% times each month you are short of age 60. In this case, same average earnings and same member at age 59, there was a reduction to $23.30, age 57.5, $21.80, age 55 is a full 30% reduction. The money purchase formula, and for those of you who calculate your retirement benefit on our website estimator, if you are less than age 60 and you find that this money purchase formula provides you the greater benefit, there is no reduction or penalty due to age. The retirement annuity is as it's paid and as it's recognized there. So in this case, age 60, 28 years, final average earnings is the same. SURS views your contributions and interest, that $143,000, adds the state match to that by adding $1.40 per dollar, which is $201,000, establishing an account value of just under $345,000. Now, we divide that lump sum by an actuarial factor. And those of you who visit our website or heard from colleagues know that our actuarial tables are revised every 5 years. And the revision will come as of September 2nd of this year. So that this table actually at age 60, it increases a slight bit, causing a slight decrease in the monthly annuity. In this case, 117.719 provides a benefit of $29.29 a month. Now, we always view both or all applicable calculations and play the higher of the two. So in this case, this person would be highest under money purchase, and that's the annuity we would pay. No reductions, no penalties. General formula, very straightforward, 2.2% per year. That percentage multiplied by an average salary based on either 4 high consecutive years or 48 months plus vacation. And the age reduction is applied if you are less than age 60 and don't have that 30 years of service. Money purchase formula takes retirement contributions and interest, adds the state match, divides it by a factor given your age. And again, the factors are changing as of September 1. For those of you who are considering a retirement within that time frame, you should have seen us. But in addition to that, there's not much, it's not a significant decrease in the monthly annuity. Typically, 0.5 to 1.5% is what I've seen. Yes?
So under the money purchase formula, if you retire like at age 58 and you have enough years of service, there's no age penalty?
Correct, correct, and exactly. So if you do choose to retire at an age younger than age 60, with money purchase, there aren't penalties or reductions. They're built into that actuarial or the life expectancy factor. So. Now with the self-managed plan, it's similar to a defined contribution plan in that you can choose at the time you leave the system to take a lump sum. You could choose to roll that account balance over or transfer it to another tax-sheltered account, which is typically what we see, because you don't necessarily want to take a lump sum in cash and have that as taxable income for the year. Or you can annuitize. Now the significance of the annuity is that you must annuitize with all systems involved, and that will provide the college insurance program eligibility. So if you want health insurance, you must annuitize the benefit from SURS regardless of plan that you choose. Okay, for each of us who don't meet the vesting requirement, there's not a significant amount that SURS is going to provide. In the traditional plan, you will receive your contributions if you choose a refund. You'll receive no employer contributions, and you'll receive 4.5% interest. Typically, as I mentioned earlier, SURS pays out at about 8% interest. So that is the penalty if you do choose a separation refund. In the portable plan, you receive your contributions and the interest earned. In the self-managed plan, you essentially receive the underlying value of the investment that you've made. Each pay period that you're making contributions to SURS, you're buying shares of a mutual fund, and that value varies depending on a number of different variables. So at the time of your departure from the system, that investment value or the account value is what you'd be entitled to. If you do meet the vesting requirement, in the traditional plan, you still aren't entitled to employer contributions if you choose to take a refund. There's still your contributions and 4.5% interest. Within the portable plan, there is a dollar-for-dollar match, and the interest earned is credited. With the self-managed plan, essentially, again, you're receiving the employer contribution and that 80 cents on the dollar match and the account value that has accumulated. As far as survivor benefits go, as I mentioned earlier, a survivor is either, within the traditional plan, a spouse, dependent child, disabled child. If you meet the vesting requirement, which is 1.5 years, that person is entitled to a benefit in the event of your death. In the traditional plan, that benefit payment is 50% of your retirement benefit calculated upon your date of death. That's payable to the spouse for their lifetime, to the children until they reach age 18 or 22 if they're full-time students. And there's an automatic annual increase that's provided each year. Now, just keep in mind, I met with a member a couple of days ago who was not married and had a dependent child. As long as that child, and at the time we met, he's 22, no, he's 21, no, he's 20 years old, and he is preparing to go to college. Now, prior to entering college, he is not a survivor. And what that meant for the member is that she wanted to consider retiring as quickly as possible before he became a full-time student, because once he becomes a full-time student, he qualifies as a survivor. She's no longer entitled to the lump sum that is within her account. Yes?
I have a question. If all my children are older than 30 and I have no spouse, I get the survivor benefit?
Absolutely. If all of your children are over age 22,
Yes.
no longer qualifying as survivors, you have no spouse, no dependent parents, you're entitled to that lump sum. And the lump sum ends up, it differs for everyone in the room, but it ends up being about 12% of your account balance. So if you have a $50,000 account balance, roughly $6,000 or $6,500 is survivor contributions. Now within the portable plan, a survivor is more strictly defined. It is either a spouse or you can name a contingent annuitant. The interesting thing about portable and self-managed is you can actually provide a benefit payment in the event of your death to someone who's not a spouse, or not dependent on you, or not related to you. Within the portable plan, you can provide a benefit payment at 50%, 75%, or 100% of your retirement benefit. But be aware that the more you provide that survivor, the more of a reduction there will be in your monthly annuity, because that is an election that you make at that time.
Can you elect not to provide benefit?
You can do that. Now, and the question is, can you elect, if you have a spouse or someone that is a qualifying contingent annuitant, can you elect for that person not to receive a monthly annuity, a survivor benefit? Yes, you can do that. They must sign a waiver that waives their right to survivor benefits.
So that increases the amount of the annuity on a monthly basis too?
It doesn't increase the amount of the monthly annuity. It doesn't decrease it. So that if you do choose to provide, if you're in the portable plan, if you do choose to provide a benefit for a spouse or dependent child, there's a reduction in your monthly annuity. If you don't choose to do that, you'll receive the same exact retirement annuity that someone in traditional would receive, unreduced. And you can still name that spouse or that person as your primary beneficiary, in which they would receive a lump sum in the event of your death.
Got it. Okay, that's interesting.
Okay. Within the self-managed plan, again, a survivor is a spouse, or if you don't have a spouse, you can name a contingent annuitant. Again, the benefit payment with the self-managed plan is purely elective in that there are a number of Fidelity and TIAA-CREF provide for Fidelity, it's the principal insurance company that provides annuity services. There are a number of choices with the principal and with TIAA-CREF that you can elect as far as providing benefits for someone in the event of your death. All right, death benefits. Now, whereas survivors are monthly payments that go to someone that you've designated, a death benefit is payable to anyone that you want to name as your primary beneficiary, at least in the traditional plan. So, and I hate to say this on video, but you could name your favorite SURS representative as your primary beneficiary. I don't know about the ethics rules and all of that, but we'll deal with that when we get there. So you can name anyone within the traditional plan. They will receive the account balance that is payable in the event of your death. Now, if you have a spouse and you're in traditional, that spouse is a survivor, and they could be named as your primary beneficiary, in which they'd receive a monthly payment and a lump sum. Or you could name someone or some other entity as your primary beneficiary. They'd receive the lump sum, and if you have a spouse, they'll receive monthly payments automatically. The one thing I want to say within regards of this death benefit is to make sure that your primary beneficiary is who you want it to be. In that, I had an instance last summer where a member in the system, two members of the system were married recently. One passes away and he forgot to change his primary beneficiary to his current spouse. So his former spouse was entitled to the benefit and we had to pay it to her. So make sure that your beneficiary designations are updated. Within the portable plan, primary beneficiary is spouse. They can waive their right and you can name an alternate beneficiary. In the portable plan, as I mentioned earlier, there's that dollar for dollar match if you choose to take a lump sum. Well, in regards to the death benefit, there's a similar feature in that the death benefit payable in the portable plan is your contributions plus a dollar for dollar match, minus if you have a spouse, a portion of that account to set aside to pay that spousal benefit. I know that sounds a little convoluted, but within the portable plan, prior to retirement, there is a benefit if you have a spouse. It's automatic and it's payable to them for their lifetime, just like traditional. It's only at the time of retirement when you elect to receive a retirement annuity that SURS deducts that 1% and you must take a reduction in your pension to provide benefits. So prior to retirement, I'm in the portable plan. If I pass away, my spouse receives a monthly payment at the time I would have reached my eligibility for retirement, age 55. As soon as I retire, I have to make an election to take a cut in my pension to provide that same level of benefit. If you don't have a survivor or spouse and you're in the portable plan and you pass away, the balance of your account, the total balance of the account, goes to the person that you've named. Within the self-managed plan, the account balance itself is payable to your spouse or your alternate beneficiary. It is payable as a lump sum. Post-retirement, it's going to be based upon your elections at the time of retirement. Again, with TIA, CREF, and Fidelity, there are a number of options that you can provide as far as death benefits. One of the things to remember within our system is that you're worth a lot more working or before you retire than after retirement. Post-retirement benefits for traditional and portable is $1,000. That's it. If you have a spouse, they're also receiving that monthly survivor benefit. If you don't have a spouse, you pass away post-retirement, the balance of the SURS account is payable to your primary beneficiary. So the nice thing is that someone will always get the assets within the SURS system. It will either be you as the member or it will be your primary beneficiary. It doesn't revert to the state as long as you make sure you name your primary beneficiary. All right, each of you, by virtue of full-time employment, and that means you qualify for benefits through COD, is entitled to participate in the college insurance program. College insurance program provides both a major medical PPO-based element and a number of HMOs that will cover you within this region. If you do choose to move outside of the state of Illinois, the PPO is the only route to take. So just be aware of that. There is a monthly premium. It does change each year. At this point, the HMO is roughly $190 per month. The PPO is roughly $240 per month, and that is for you, the member. For your beneficiaries beneficiaries or dependents, it is very expensive, almost prohibitively expensive, until that person is Medicare eligible. So prior to being Medicare eligible, it is in a range of $600 to $900 per month for dependents. And that's, I'm assuming, over age 23. Post Medicare eligible, age 65, the premium is within a range of about $280 to $350, but does provide prescription, dental, and vision coverage. So it's a very good supplement to Medicare.
Whether there's a pre-existing illness or not?
There is not a pre-existing condition period tied to the college insurance program, so no. And this is a wholly separate program from the one that you're provided as an employee. So there may be similar names, but they are wholly separate programs. And if you have the opportunity to continue within the group program here, that's between you and Sue and COD. Once that coverage would end, then you can move on to the college insurance program. And for those of you who have been employed or even possibly colleagues that have at least 5 years of employment at a state university, they have an interesting feature. 5 years of service means that they would qualify for the state of Illinois health insurance program in addition to this college insurance program. So for those of you who have an opportunity to work at a university, part-time or full, and it doesn't have to be continuous service, it can be a semester here, a period there. As long as you meet the 5-year requirement, you'll qualify for both plans. And if you have a total of 20 years of service that the SURS benefit is based upon, The state plan is at no cost, no premium. So keep that in mind. Okay, each of us has something, or a number of things to do at the time you're electing to retire. And in fact, what I would suggest is probably 5 to 8 years prior to that. It's when you need to start looking at SURS very seriously and keeping abreast of the legislation. There are a number of things you do, there are a number of things your employer does, and of course, the retirement system. For us, for you, the member responsibilities, of course, and I've met with a number of you as far as retirement counseling, is to take advantage of SURS as a resource, both individual retirement counseling appointments on the phone or here on site. Visit our website. It's a wonderful resource as far as calculating retirement benefits and just keeping you up to date as far as the most recent legislative changes to our system. There is a retirement preparation checklist that each of you receives if you have a retirement counseling appointment. It's also available at our website. Just gives you a very general overview as to the number of things that you should be looking at and considering prior to retirement. The application itself, and don't laugh because there are a lot of people that will meet with me and think that that's their application for retirement. There is actually 64 pages of paper that you can download from our website, of which you complete probably 5 or 6 pages. So there's, we're not saving trees, but what I'd say is save it as a PDF and you can print off the pages you need. But please complete the application 90 days prior to your date of retirement. That ensures that on your date, we will issue a check. The benefit is payable the first of each month. So make sure that you give us that time. Yes?
Can you fill out the application online?
Can you fill out the application online? No, sir, not yet. So it is, at this point, paper that you would submit to SURS.
Does the college have them here?
Typically, the college does not because we update it from time to time. So the most recent version is available at our website. And this last point, and again, I'd say don't laugh. Notify your employer. There have been a few instances where I've met with people and they've retired and they haven't told their employer about it. And I don't want to delve into the relationship there, but make sure they are aware because there are a number of reports that are generated. So, all right, your employer's responsibility, of course, is to document everything and process the final payments, both last payroll information for sick leave payments or vacation payments or any payment that is due you. They submit a termination report to SURS typically between 30 and 60 days post-retirement. That termination report lists everything from the number of sick leave days you accrued, vacation, last rates of salary for the last few years. It's a cornucopia of information that we use to establish your retirement benefit. They also verify academic contracts, which is, I'm sure, quite a tedious job, and verify any part-time service. Our job is, of course, to gather all of this information together, request it if we don't receive it, and accurately calculate your claim. As I mentioned earlier, we utilize the highest of the general formula or money purchase formulas. We use the highest of your average salary, whether that's 48 months plus vacation or high for consecutive years. So our job is to ensure that you receive every dollar that you're entitled to.
What's the maximum you can lock in by time?
As far as
there's a change coming down the pipe, which is going to be worse than you really want. You put in retirement prior to that lock-in.
That's an interesting question. Is it possible for you to avoid future law changes by retiring at an earlier date, just to make sure that you're insuring yourself to what the law states at the time as of retirement? It depends on how the laws are written. Typically, they're not retroactive, so that if a law change occurs, it occurs on a date in the future for retirees after that date. Now, the interesting thing about this retirement system and all the state retirement systems is that the Constitution dictates that this benefit cannot be diminished or impaired. We take that to mean that law changes that diminish our benefit, well, are unlawful, so that Your benefit and my benefit, as it stands right now, cannot be reduced. Now, the law can change and has changed for members that are future hires in our system. As you saw in one of the earlier slides, for members hired after July of 2005, they no longer have that money purchase formula to calculate the benefit under. So law changes can affect future hires, but our benefit is guaranteed by the Constitution. So it must be paid regardless of, and this is not anything that I would want to see, but regardless of if SURS is as a $14 billion retirement fund, as everyone probably knows, the state isn't funding us appropriately. And if that $14 billion were to disappear, your pension benefit must be paid. So if it comes out of general revenue, if it comes from a conglomerate of state pension plans, it must be paid. So I'd prefer to have a job and try to administrate those payments, but it must be paid. The preliminary payment is the first payment that SURS issues to you. Typically, it is payable for the first 90 to 120 days of retirement. It is about 80 to 90% of what we know that you're entitled to. We know you need income, but we actually post-calculate your retirement claim so that giving us that 90 days entitles us to the time to calculate it correctly. For those who have reciprocal time, that would necessitate closer to the 180-day period for the PEP. So just be aware, if you do have reciprocal time, the reciprocal system will not pay you until that 6-month period has expired. SURS will pay you the reduced amount for that length of time. You'll always be caught back up. Just make arrangements to make sure you have assets set aside. At age 50, we start bothering you for your birth verification and marriage license and birth certificates for spouse. So just make sure that we have those before retirement. All right, for those of you who are entitled to both a SURS pension and a Social Security benefit, there are a couple of provisions that affect your Social Security benefits. The windfall elimination provision affects anyone who is entitled to both SURS and a Social Security benefit based upon their own work. The governmental pension offset affects a benefit from Social Security if you're expecting that from a spouse or former spouse. In a nutshell, the Windfall Elimination Act can reduce your pension by roughly half. The governmental pension offset can reduce the benefit that you were expecting to zero. Please visit Social Security to get some more detail on how these provisions affect you. But just be aware that the way that your pension calculation is done from Social Security at this point does not reflect your SURS pension and the reductions. I am aware that there are provisions of our law now that mandate that they begin recognizing both the windfall elimination provision and this governmental pension offset, so that future benefit estimates will reflect reductions, but I'm not sure exactly when that'll be implemented. Another piece or element to consider with Social Security, and this is not real intuitive. I mean, to me, I typically want people to retire, but this is kind of the opposite. As long as you are not receiving the SURS pension, these provisions aren't implemented. I have a number of members that reach age 65 or 66 or whatever the full retirement age is for each of you. Once you reach that age, the earnings limit for Social Security goes away so that you can receive your full Social Security benefit while being employed and not receiving the SURS benefit. But as soon as you begin receiving our pension, these provisions will be implemented. So I have a few people that are working well beyond their full retirement age with Social Security just to entitle themselves to that benefit as it's unreduced. All right, this is from our attorneys. I think this is nice and succinct from an attorney. We can't provide much information about Medicare other than to say you're eligible at age 65 if you qualify for a Social Security benefit. And I probably already said too much. So we'll leave it at that. There's our prompt to our promotion to get you to go out to our website. I won't go into a lot of detail other than to say it will take you less than 10 minutes to register for the website. It's a very nice tool to utilize once you're registered because it migrates all of your personal information into the web estimator. All you enter is about 4 or 5 pieces of information, and you can calculate your retirement benefit to your heart's content. So it's a great tool to use, and it is very accurate. I appreciate your presentation. I we may have squelched a few questions with the fact that this is being broadcast throughout the campus, but please feel free to ask questions. And as I mentioned earlier, there are no dumb questions about this pension plan. Yes?
I currently I'm in the self-managed program, and I have 6.5 years of service credit. My husband is thinking about taking a job out of state next year, and I'm trying to decide whether or not I should stay until I have 8 years of service credit to qualify for an annuity. Can you give me any guidance on that?
It's a very tough set of challenges there. The question is, within the self-managed plan, the member has 6.25 or so years of service now and is considering whether she should continue to reach that 8-year requirement so that it can be entitled to benefits and the retirement benefit and health insurance at whatever age 55 or whenever you're eligible. Typically, well, I'd have to actually sit down with you. I would suggest, if it's possible, trying to get to the 8 years because it just provides you a better universe of options. You can always leave the assets here, even at the 8-year point, and within the self-managed plan, because you do have a finite number of dollars, they will continue to grow and you can continue to earn interest. And you also have the opportunity to start the retirement benefit, to receive the health insurance. So I would lean toward getting to the 8-year requirement, but I appreciate the fact that you've gotten the 5 years in, so you could wait until age 62 to do that. And with self-managed, you also have the opportunity at the time you leave employment, if you don't need health insurance and you don't foresee that being of any value, you can choose to take a lump sum and accumulate this with other assets that you have. Yes?
2 things, one for everybody and one for you. SURS has offered in the past, I don't know if they have one coming up, a pre-retirement seminar, which is an all-day event down in the Champaign office, and I want to say it was great.
Good, thank you.
I don't know if you want to tell them.
Yeah, it's everything you ever wanted to know about SURS in an all-day experience. We have retirement counseling, and I believe the SURS segment is probably 2 hours. We also have other professionals come in and speak about financial planning and wills, estate planning attorneys. So it's a great experience, and it's very, very economical. I think $20 or so.
And then my question to you is, I have a pretty good handle on all this, and I've met with you once and another counselor once before, and I'm retiring this May. Should I make another appointment to meet with you, or is it not necessary?
I think you're pretty much in the chute. So if you're looking at a May retirement, there's not much that can affect things positively or negatively, which is great. So congratulations. Okay, well, I appreciate your time and your questions. I'll be around for a while, so thank you very much.